sometimes the most successful folks are the ones that look at it and say, what could I do with this? It doesn't mean that you buy yourself a project. If you're not in the field of changing properties, like if you don't have the team, the construction team to make a fundamental shift in what that asset is, don't do this. But I've seen some people do some pretty extraordinary things where they're looking at land and they say, hey, can I make a mini home park here? Or they look at a building and there's like, what could we make this building into? Mixed use? Could we do some really cool stuff with it? And those people tend to always be successful.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 367. My guest today is a tax attorney who has worked with real estate clients for over 20 years, and in that time has come to recognize the choices and strategies that separate the successful investors from those who struggle. Toby Mathis is a founding partner of Anderson Business Advisors with tens of thousands of clients nationwide. Toby advances his clients' interests by combining expert tax advice with his personal experiences investing in over 200 of his own real estate projects. He's also an award-winning writer, and his recent book was an Amazon #1 bestseller called Infinity Investing: How the Rich Get Richer and How You Can Do the Same. Toby, thanks so much for being on the show.
Hey, thanks for having me, Brian. This should be fun.
Give us an update on who you are and how you became a tax advisor or tax attorney on this topic.
That was actually kind of a roundabout way. I never really intended to go to law school. I had a great mentor. My dad was corporate America, worked for the Boeing company for over 30 years and was like, don't work here and go do your own thing. And he had lots of friends that owned franchises. And so he'd rent me out to them. I'd go put my time in and learn as much as I could. But I had a great mentor that was an independent business guy. He and his son and I went to high school and college together, and I just got lucked out. He just said, hey, guys, my attorneys are always screwing up our deals. Can you guys go get your law licenses, please? And he actually tried to as well. He got thrown out within 6 months because he was older and opinionated, if you know what I mean. So the son and I both got licensed. His son is a fantastic ERISA attorney in California, and I do this. I set up my own shop right out of school and never really intended to be traditional law. I always wanted to help the small business person / investor. It seems like a lot of small business people are investors. They're entrepreneurs in spirit. And he happened to really like real estate. He also realized that you had to get a tax background. He's like, you need an accountant. And this is a kind of I'll give you the synopsis. I was super poor. I was living in a 400 square foot studio trying to get my firm going. And I saved up $300 to meet with an accountant. And I sat down with his accountant and he made me feel like an idiot. Made me feel like I shouldn't be in business. Was just so arrogant and used big words that I had no idea what they meant. And I walked away from that meeting with a real sour taste in my mouth saying, if this is what this is like, I could learn this stuff and easily make it understandable to the business folks, because I'm sure that they're just throwing their hands up going, I have no idea, just do my return. Maybe that's the whole purpose of that type of behavior. But I just found that it was almost shaming the individual. I felt really embarrassed, and I just kind of took it. You don't really learn taxes in school. I don't even think if you're a CPA, you're really learning taxes. Maybe if you get your federal license as an EA, you learn how to do prep, but it really has to come from experience. And over the years, it's been about 25 years since I started. I would say that if I was going to give one piece of advice to investors is hire professionals that do what you do. You don't learn it out of a book. You don't learn it in a weekend course. You certainly don't learn it in school. You learn it by doing it. And it's completely two different worlds. Those professionals, attorneys and accountants, EAs, can go into all the differences, but there's those people that actually invest and know the nuances, know what real estate professional status is, know what passive losses are, what the exceptions are, active participation, material participation, all these different things, how Airbnb is different than a traditional. There's people that know that because they're doing it. And then there's somebody who you bring your taxes to, and you hope your CPA knows what it is, and they don't even know the issues. And so they just prepare your return. And my experience is most of the time it's not in your best interest, and most of the time it's done wrong. You really want to be working with people that do what you do.
And I would just add to that, based on what you said, hire people who are actually going to be patient and answer your questions without making you feel like an idiot. Tell us about the type of clients that you have and what you do for them.
I love our clients. We have tens of thousands. I think we're somewhere right around, I don't want to get into all the numbers, but my firm has about 500 professionals and staff that do asset protection, tax planning, and legacy planning all around the country. And so we have tens of thousands of clients. Over the years, you just start accumulating, like ones that are kind of your favorites are the ones that are, a little more out of the box, or they're passionate about something. But just about everybody is a real estate investor in our group. We teach traditional investing too, to try to get them to diversify, but they have that entrepreneur spirit, which if you've ever been around an entrepreneur, you know what I'm talking about. It's shiny toy disease to a certain extent. They're always willing to talk about a new idea. They love it. They're passionate about it. And I've seen people make money moving sand. I've seen people make money coming to, with brand new, great products. I've seen people make money in real estate in so many different ways that I just love learning new stuff every day. And my clients teach me all sorts of new stuff on a continuous basis.
When you think of, let's say, your top 10 real estate related clients, what are some of the common denominators that you see that makes them achieve more success?
The folks that I think of, I can immediately think of some folks doing, the 8 figures a year, 9 figures sometimes. Those people are number driven, and they don't say no very often. They say, will this work? And how could this work? And then eventually be like, it doesn't work for me now. Like, you never see them just like slam the door on things unless it's like somebody's doing comps. If they ever have their realtor like, hey, in this neighborhood, houses are going for this, they'll probably just hang up at that point. It's like, nope. Most really successful real estate investors operate off of numbers. We don't particularly care what the property looks like. What we care about is what it's going to generate. And it's an asset. It produces money. So you want to look at it and say, how is this property going to do that?
Are they looking just at the numbers, or are they also then asking the question, well, if it doesn't quite pencil out, how can we make it pencil out?
I think that they do, what else could I do with this property? So a lot of times you'll look at a land or a building. Actually, there's a really good example. There was downtown, I won't tell you who it is, but it's a relative of a very famous couple. And he was doing assisted living. So he wanted to do senior assisted living, and he was looking at different types of properties. And there was an old butcher shop in downtown Ogden that they turned into a assisted living, very successful, exited it really well. But he'd always tell me, hey, when I look at a property, I'm like, what else could we do with that property? So everybody looked at the butcher shop, and it was kind of in an area that, this wasn't going to be wasn't the same old, Main Street thing going on. It was just going to sit there. Nobody really wanted the building. Nobody knew what to do with it. And he said, what could this be? It had beautiful awnings. It had kind of that Main Street look. What could we do with it? He turned it into senior living, of all things. You see shopping malls that get turned into storage. You see some interesting things like that. So sometimes the most successful folks are the ones that look at it and say, what could I do with this? It doesn't mean that you buy yourself a project. If you're not in the field of changing properties, like if you don't have the team, the construction team, to make a fundamental shift in what that asset is, don't do this. But I've seen some people do some pretty extraordinary things where they're looking at land and they say, hey, can I make a mini home park here? Or they look at a building and there's like, what could we make this building into? Mixed use? Could we do some really cool stuff with it? And those people tend to always be successful.
There's looking at the property, looking at the potential, and maybe adaptive reuse kind of things like you just described. But if you take it a level deeper, where you come in as a tax attorney, what are some of the tax strategies that you see successful real estate investors employing?
I'll put it this way, Brian, like there is a default that everybody uses, the 27 and a half year and the 39 year for non-residential property, 27 and a half years for residential, where they're deducting a structure. That's an impermissible use of that you're actually not supposed to be doing that. You're actually supposed to go into the property and break it down into its components. The IRS will allow you to do that. They're like, if you want to write it off over a longer period of time and not take the deduction now, you certainly can. But if I have carpet or if I have removable flooring like laminate, I don't want to write it off over 39 years in a non-residential building, or I don't want to buy a single family residence and then write off the carpet in 27 and a half years. That's silly. And then I don't want to pay tax for it when I sell it. Like I have to recapture that nasty carpet that's sitting in the house. That just doesn't make much sense. And so I like to break them into its components and do something called cost segregation. And you accelerate your depreciation, and it creates big fat losses is what it does. Like on a typical structure, you might write off a third of it in the first year, or you're going to spread that out over the useful life of those assets, like the 5-year property, the 7-year property, 15-year property. Somebody buys an apartment building or whatnot and puts in a courtyard, puts in a new driveway or a parking lot. All that stuff, that is not 27 and a half year property. That is 15-year property. You should be writing that off in half the time, which means you'll pay less tax. You'll show less profit because it's a deduction. To do otherwise is basically giving a tax-free or an interest-free loan to the government, which, if you want to do that, go for it. But otherwise, most pretty savvy investors are looking at it going, how can I offset my income this year? And they're pushing it forward. Hey, if I want to have a taxable event, I can exit. If I want to have a taxable event that I'm not going to buy more real estate and I'm going to show net profit, rental profit, it's up to them. But if they don't want to pay the tax, they always have a route that they could go to eliminate that tax. Hey, I don't sell the property, I borrow against it. Hey, I buy additional real estate and accelerate its depreciation so I don't have to pay tax on rents for my other 2 properties, things like that. So they're actually looking at it strategically to say, is there a way that I can kick the can down the road? And by the way, we all get a get out of jail free card from the tax man by dying. All of our basis and all of our assets steps up when we die. So you don't have to, don't sell things right on your deathbed, right? Hang on. And your heirs will have no tax on it. I don't care whether it's, $5 million of gain. They don't pay tax on it. You get a step up in basis. And so the trick is don't sell your stuff, leverage it, use it in a tax-free way, minimize your tax burden. The idea is that eventually you'll pay the tax, but if you die, then you don't. So you just keep pushing it down, pushing it as far out as you can, and eventually pass away. That's the rich strategy is the buy, borrow, die. It's like you buy the asset, borrow it to buy more, and then pass away some point. And that's a good strategy. It works great. And all you're doing is trying to defer, and hopefully you never have to pay the tax.
What are some of the other successful tax strategies that you've worked with your clients to employ?
Well, you do your 1031 exchanges, obviously, which is just trading more real estate. So if I'm exiting a project, then as long as I buy another project or have another project in the wings and you could do a reverse 1031 exchange, traditional Starker exchange, those types of things, a lot of people are familiar with. The other one is when you cost segregate a building, you can bonus depreciate a lot of that deduction into year one. So let's say that I'll use carpeting. I could write off carpeting in 5 years, or I can write it off in 1 year. I could just choose to accelerate that depreciation. In real estate, one of the weird areas is short-term rentals. It is not considered rental activity. So if you have a high-income person, let's say it's a doctor making W-2, we encourage them to get into Airbnb or VRBO because that's a traditional business. Even though it's renting it to guests, it's treated like any other business. And what that means is the losses aren't necessarily passive. So if I have a long-term rental, that income and loss is passive, and passive losses can only be used against passive income with a few exceptions, active participation or something called real estate professional, which I'd be happy to get into the weeds on those ones with you. But most people, if they have a W-2 job and they're not doing real estate full time, they're not gonna meet that test. So this weird area where if I buy a rental property that if I Airbnb it that first year, which means I rent it to individuals for 7 days or less on average. So if I rented it for 50 days total and I had 20 rentals, I'd have 2.5 days per rental. That is not a rental activity. That is literally like having a pizza shop or having a different business. It's not passive loss. And so if you're that doctor who's making $700,000 a year and you're a really high tax bracket, you buy that Airbnb, and if you self-manage that thing, what you call material participation, if we accelerate the depreciation, if we do that cost seg and we create a big loss, you can offset your salary with it. And so we could buy a property where we can create $100,000, $200,000 loss in year one, and they just saved $60,000, $70,000 in taxes. So they could almost put back the money on the investment in that first year just with the tax savings. So that's one of our favorites, because we kind of look at it saying, hey, the people that are usually outside the game, like, hey, I don't get any tax benefits from my real estate. It's not that exciting. Like, hey, you're not paying tax on my rental income. Yay. But they want more. That's one of my favorite strategies, and it works like a charm. And you could just do it in 1 year and then make it into a long-term rental after if you felt like it. What really matters is during the year, like even now, you could, any time before the end of the year, you could put a property into service. If it qualifies as short term, it doesn't matter whether it was in service for a month or 6 months. It doesn't matter. I can accelerate that depreciation and write it off in year one, just like a doctor might buy equipment at the end of the year. As long as they put it in service before the end of the year, they get to write that equipment off this year. Like, it's going to offset their taxes this year, even if it was in service for a week. So there's lots of cool little nuances like that in the code that can give you some benefit. But that's a really big one, usually for high income folks.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What are some of the mistakes that you see either your clients or other people making when it comes to real estate investing? And what are some of the problems those mistakes have led to?
I can use a really good example. I'm not a big fan of flipping. I know there's people that love the shows and they watch it, but the vast majority of pain in my clients as investors, I can narrow them into two categories: trying to be a trader in the stock market and trying to be a flipper in real estate. I look at those things and I've seen more people do more harm to themselves doing those two things than just about anything else. So on the real estate side, it's when you get in and you think you're going to get a property. Unless you're a contractor, you need to go and learn your ABCs really intensely, because you may be stuck with a property. And so I live here in Las Vegas, where in 2008, we had 75% of our value get erased in our real estate. And everybody that was holding on to these properties that were going to flip them, heck, they're doing it right now. Like, I know that people were buying multi-million-dollar houses to fix up and sell because there was no inventory. And now all that inventory is sitting around because interest rates made that same house twice as expensive, right? So time is not your friend when it's a flip and the market's going down and these people get stuck. And I still remember I ended up bailing some clients out of a project. It was in Baltimore and it was just horrific. It was a flipper guy, and they had a realtor who was doing after repair values, and it was all Primrose Path stuff. And these people bought these properties expecting to be able to flip them, but that was a city where they make it very difficult to do anything on a property. And it could take months to get permits. And the next thing you know, you're sitting on these things. Usually they're using hard money, so it's expensive. And then the contractors take advantage of you. And you're in an area where it's just not conducive for somebody trying to do a flip or to be a landlord. And so the default is, hey, if my flip goes south, I need to make that into a rental. It needs to cash flow. And none of their numbers penciled. Like I use cheat sheets, and it was like, yeah, I would never have touched these. But I'm looking at it going, oh my gosh. Now, but here's the punchline though, is time tends to heal all wounds in real estate. If you could suffer long enough, you'll be okay. And so even there, it's just hold on, 5 years later, it's pretty much break even. 5 years from now, it'll probably be a very success. And you could try to pretend like it was all intended. But real estate's one of those weird areas where if you can wait, you'll usually be rewarded. But where people make the mistake is they don't have that flexibility. They're either too tight, they don't have the funds to carry it if they do have a project go awry, and they end up getting stuck and they're having to exit something unintentionally, like they're being forced to exit because they cannot carry it any longer. Those are the people that usually get hurt.
What are some of the IRS red flags that you always steer your clients away from?
There's some big ones, right? So in my world, I'll just give you the facts. You go into business, you could be A or B. A gets audited about 1,500% more, 1,500% more. I'm not misstating that. A loses those audits 95% of the time on average. A pays an extra 10% on all of their income. Or you could be B, where you pay your audit rate is reduced by over 1,000%. When you are audited, you still win about it's not 50-50, it's probably about 60-40. 40% win rate, but you have a better chance than 5% success rate, right? And then you save more money. And that's the difference between being a sole proprietor and an S corp. And it's so infuriating because, again, so many practitioners out there are like, do this. And I'm like, you're not even looking at the data. If you looked at the data and you did the tax returns and you did the audits, you'd understand that these people, like all of the reasons the accountant tells you to operate as a sole proprietorship are the reasons the IRS is going to toast you. Oh, it's easier. You don't have to keep as many records. And that's not true. The record keeping requirements on a sole proprietor is the same as an S corp, same as a C corp, same as a nonprofit. It's always, you got to keep accurate records, books and records. And it just drives me absolutely bonkers because I see these guys come in, especially real estate agents. Love the real estate agents, but they tend to have a little bit of attention deficit disorder, right? They tend to be running a little fast, and somebody will slap an LLC over them and say, just operate as a sole proprietorship. And they just, they end up being, they're trying to write off 100% of their car, and they're doing the home office, which is a separate form. You may as well just, say, please audit me. And they end up in trouble because they don't keep really good records. And quite often they find themselves in hot water with the IRS, and then they're mad at the accountant. The accountant says, I didn't tell you to do that, and it usually ends up being a bad situation for them. So like, that's probably the big one that I see. Otherwise, there's really no red flags. In real estate, I'll just give you our numbers. We do about 10,000 plus returns a year. We had less than a dozen audits last year. And I'm not misstating that. Like, if you do plain vanilla real estate investing, you keep your income realistically, over $1 million, you start to go up. I would say under 500,000. So like, if we can control your income by using real estate to offset it, you don't get audited. It's like a 0.1% chance. If you're under 500,000, if real estate's not a red flag, they look at it and say, you probably could do even more with it. So we're not really going to bother you. There's no return there. The IRS, if you look at their stats, and they put a publication out every year, they like to audit the poor folks, and the earned income tax credit is the number one. So here's my advice to all you out there. If you never want to get audited, don't be poor, and don't be a sole proprietor.
You wrote a book on infinity investing. And I'm sure we could do a whole podcast episode on that topic. But if you don't mind, kind of give us in a nutshell what that book is about and what you mean by infinity investing.
I wrote it as a labor of love because we do all these tax returns. So there's not a single idea in there that's my idea. I steal it from all the successful people. And you'll see there's a lot of mentors in there that I just use as case studies. But the philosophy is really simple. If you want to be financially independent, it means that you can do whatever you want to do whenever you want to do it. And having to work full time could impede your ability to do what you want to do. So infinity just means I have enough passive income sources coming in that I don't have to work. I don't need my salary. So I could stop. I could go travel the world if I wanted to, and I have enough money coming in that it's not going to change my lifestyle. So the infinity part of it is I have an income source that goes on forever. So like a rental property is a good example. A rental property doesn't get depleted. A rental property just keeps kicking out money. 200 years from now, it's going to still be paying you rent, probably a lot more than it is now, right? So that's an infinite income source. If I buy a good company in the stock market, like you have the stock market just getting trounced this year, if you are an infinity investor, you're not. Like 2 of our funds are up. One of them is about break even. And it's because they tend to focus on the income that's coming out of a company rather than the actual price you pay. And I use this as an example. You would freak out if there was a ticker signal over your house. And every day you drove home, it told you what your house value was, right? That would probably drive you a little bit nuts. If every day I drove home and it said your house is worth X, then the next day it went down 10,000. You'd be like, whoa, what do you mean? Oh, you're in the red. Like the price of that property is just declining. Don't do that in the stock market. One of the best things I could tell anybody as far as what successful investors do is they take their right hand and they put it underneath the right butt cheek, take the left hand, put it underneath the left butt cheek and sit on them. And they just are patient and wait. And you let the income come in. If you have a good, like a dividend king, dividend aristocrat, you're not going to be too worried. You're going to be fine.
How are you taking these concepts of infinity investing and applying them? I know you own 200 properties or 200 units. Like, how are you directly applying those principles to your own investment portfolio?
I buy assets that produce income. That's what I don't really care what the value of my portfolio is. I just look at what the results are. So my partner and I have been investing for 20 plus years. We look at it and we say, how much income can we produce on a monthly basis from those sources? We don't particularly care about the value of the underlying assets. And it works great. If you're forced to sell, you're going to care about the value of your assets. But if you're not, you don't really care unless you're going to lever that asset. And then you might care a little. What's
your favorite hack in your business or your favorite app that you use all the time?
The one that everybody uses is Mile IQ. Like, it's just kind of this weird thing where, like, right off your mileage, gas is so expensive right now. You can get pretty good. If as long as you're tracking your mileage for business, it can reimburse you and you don't have to pay tax on it. So that's a real simple one. Otherwise, I wouldn't really say that there's a great hack other than the number one life hack you can have as an investor is have a bookkeeper. Have somebody that's counting everything that you're doing so you don't have to, that can give you reports that aren't influenced by, hey, I really think this property is, maybe it's worth more, or playing around with numbers. No, you want numbers to be black and white. You don't want to let your emotion influence, let somebody else track that stuff for you. And then actually look at those numbers at least quarterly to make sure you're on the right track.
And what are the reports your bookkeeper presents to you each quarter?
It's always a P&L and a balance sheet. I want to take a look and see what my assets and liabilities are. And this isn't fair market values, by the way. This is just what I paid for it, see what my depreciation looks like. And then P&L, just even if you did it individually. I do something called the Infinity Calculator individually, where it says how many days I could survive if I quit working today and I just lived off of my rents, royalties, dividends, interest, and capital gains. Right. If that's all I did, how many days could I survive? And when you hit infinity, it's a good feeling because then you don't have to work ever again.
Tell us how our listeners can find out more about you or get a hold of you.
It's real simple. You just type in Toby Mathis in Google and you're going to find my YouTube channel. Just subscribe. It's free. You can always, I put out a couple of videos every week. If you want the tax side, we also have at Anderson Advisors, real simple. We do something called Tax Tuesday every other Tuesday where you can bring all your tax questions. We answer them for free. And we do a really cool class every 2 weeks called Tax and Asset Protection. It's not enough just to go in and say, hey, somebody do something for me. You got to understand what they're doing and why. And so a little bit of education goes a long way. Come on in. We will teach you the principles. We will teach you the basics. If you're a real estate investor and you don't know, we'll go into everything from dealer status to long-term rentals versus short-term rentals to accelerated depreciation to bonus depreciation to cost segregation to accountable plans, how to get more money out of your business tax-free. All that stuff we do absolutely as a courtesy so that you can educate yourself. And then if it's a right fit, then you reach out to us.
Toby, thanks so much for coming on the show and sharing your well-earned insights from what successful investors are doing, the tax strategies that they're employing, and then the things, your suggestions on staying out of trouble and some of the things that you would warn against. Very valuable insight today. So thank you so much. I've really enjoyed this conversation.
Appreciate it. Thanks for having me on.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.